What's up, YouTube? It's the Money Man here, and today we're talking about schools of investment. And today's school is value investing. So, value investing was founded back in the day by Benjamin Graham when he was first teaching way back at Columbia Business School and the New York Stock Exchange, presenting investment ideas. So, his theory is that stocks that are discounted according to their book value per share, their price to earnings, or other intrinsic value is what will pay out in the long run if you buy it cheap and wait. Book value per share is the equity in a company divided by the number of shares that are outstanding. So the higher the book value per share, the better. Now you need to take that and compare it to how much you're actually going to buy the company for, which would be its actual share price. By comparing those two, you can get a feel for whether or not the company is being currently overvalued or undervalued based upon its equity and assets. The price to earnings ratio is the price per share of a stock over the earnings per share of a stock. What this tells us is how many years of earnings until you actually get back inside the company the price that you're paying for it now. This is a good tool to value investors because it tells you how much more money the company is going to be bringing in versus how much you're paying for it right now. The whole concept of value investing is doing your homework, investing in a company that is undervalued, and then holding it long term until you get that value out of that company. There's a couple of different thoughts on the quality of a company that you're investing in. Some value investors don't care about the quality, they just care about the numbers matching up, while others, such as famously Warren Buffett, care much more about the long-term prospects and quality of a company and the ethics of a company. Buffett is the most famous value investor, but even still, he doesn't follow Benjamin Graham's school 100%. Stocks become undervalued in lots of different ways, but basically the big one that Benjamin Graham mentions is the big hand of the market. Now, he created this persona called Mr. Market, and that is people buying and selling things irrationally instead of just rationally off of fundamentals and news and more information. Value investors will never be the ones that buy growth companies or big popular blue chip companies that are skyrocketing in value. The other thing that they stay away from is companies that don't have a lot of history. If the industry itself does not have a lot to compare to, generally value investors will be staying away. Another thing that gets lost a lot when talking about value investing is that Benjamin Graham actually built in a way into the school of investing in order to not exactly time the market, but use his feel for it and take advantage of it. He recommends, after a market crash, of going heavy into equities and still maintaining or holding a slight position in bonds, generally 75-25 being the most extreme. And then as the market increases and as you're making more money from equities, you slowly shift your money back to bonds. So that way, the closer you get to a potential market crash or just even a downturn in the market, your money is a little bit safer. I think value investing is a great school of thought when it comes to investing, mainly because it just makes common sense. The amount of money that you're paying for a stock being extremely relevant for how much money you can potentially get back from the stock is a nice ideal. And if the company was entirely private, it would just make sense. Unfortunately, because you're dealing with a public company, the market, and quote unquote Mr. Market in this case, is what really determines the price at the end of the day and whether or not you make or lose money. So market psychology would play a bit into this. Unfortunately, value investors don't take that into account. That being said, most value investors wind up becoming extremely successful over the long term, and that gives a lot of credence to the school of thought. Some of the more famous value investors, of course, are like Michael Burry from The Big Short, if you guys have seen that movie or read that book. And then, of course, Warren Buffett, who I've mentioned like at least 3 times in this video. Don't hate me for it. The best resource for more information about value investing and all of its ideas, concepts, principles definitely come from Benjamin Graham's and Dodd's The Intelligent Investor. I highly recommend that if you're interested in value investing at all, you go and check out this book. Thanks guys, I hope you like this video. More Schools of Thought to come out soon. Please like my videos, comment on what you'd like to see, subscribe if you enjoy it, and I'll see you guys later.